Bismillahirrahmanirrahim. Hello everyone, back to my courses Macroeconomics. We'll carry on our discussion of chapter 1, gross domestic product. We are in part 4. Actually, I said part 3 will be the last, but unfortunately we couldn't finish and end with our discussion of this chapter. Anyway, we'll carry on our discussion in this one. So part 1, I provide the link here below, also for the part 2, in which we give and we introduce the macroeconomics concepts and definitions. In the part 3, we looked at how to measure the GDP, and we discussed different, elements of flow and stock, what is included and what is excluded, nominal versus real GDP. I give an example, and then real GDP using chain volume. In the part 4, we're going to see what are the components of GDP, approaches of calculation, and limitations of the calculation of GDP, or the limitations of the GDP merely. Okay, components of the GDP. Components of the GDP are consumption, gross domestic investment, government spending, net export. Okay, back here, personal consumption is the former name of the final consumption. Now we use the final consumption. As well as gross private domestic investments is the former name of the gross capital formation. Okay, so anyway, final consumption includes goods and services. Goods that could be divided into durable and non-durable goods. So if we start with non-durable goods are any consumer goods in an economy that are either consumed in one time or used up over a short period of time. In the United States, we use usually less than 3 years. Over 3 years, we use, we can consider as durable goods. Anyway, so non-durable goods are also called soft goods or consumable goods or consumer goods. Some examples of non-durable goods include food, clothing, light bulbs, etc., etc. Okay. However, the opposite of non-durable goods are durable goods, and durable goods are also called hard goods. Okay, or consumable durables, consumer durables. Sorry. Some examples of durable goods include cars, consumer electronics, home appliances, and sporting goods, etc., etc. Okay, and it is actually worthy to mention the difference between durable and non-durable. Is that durable goods are affected by the cycles. They increase with the economic growth, and they decrease with the economic recession. However, non-durable goods, they are not affected by the cycles, and they keep stable no matter the economic situation. Now, real estate, is it considered as a durable good, or as gross capital formation? Real estate actually, or the acquisition of dwellings, is considered by national accounting or macroeconomic accounting as is treated as gross capital formation, not a durable good. Okay, so real estate is a durable good. But according to the national accounting, to the SNA, the system of national accounting, it is a gross private domestic investment or a gross capital formation. Actually, final consumption, as we said, it's included, or it could be broken down into final consumption expenditure of households, final consumption expenditure of general governments, and final consumption expenditure of non-profit institutions serving households. So for the dwelling, actually what we consider only services of owner-occupied dwelling. So those are imputed as final consumption. But the acquisition of the dwellings by households, the houses, apartments, whatever, so those dwellings that are acquired by household are treated as gross capital formation. Okay? So in a nutshell, consumption include spending by households, and like I said, general government and institutions serving households on final products such as clothing, televisions, dish washers, computers, education, banking services, iPods, cars, foods, etc., etc. Okay. Now for gross capital formation, or what we call investments. So investment represents purchases by businesses. It will be machines, equipment, company-owned buses, forklifts, trucks, suppliers, buildings, all these things. So, including, the dwellings. Okay. Some goods may have been produced but not sold. So remember, that we, in the GDP, we consider the production. We not consider the sales, not sales. So GDP measures production, not sales. So investment in economic terminology does not mean the purchases of financial products, because those financial products such as stocks, bonds, etc. are traded and are merely kind of a transfers of ownership and do not directly represent the production. Okay, so fixed investments includes non-residential structures, equipment, softwares, etc., and residentials, like I said, for the dwellings, and also the changes in inventory. Okay, changes in inventory. For the government spending, here the case of United States, federal, state, and local level. Case of United States. In other countries, could be the government and the parliament, etc. Okay, and the local as well. So regional, national, regional, and local. And then exports minus imports, which represent the net exports. Now the GDP per capita, or per capita GDP, or GDP per person, or GDP per individual, whatever. So per capita GDP is the value of gross domestic product per individual. So simply we divide the GDP by the population. Okay. So in the United States, for example, if it is 21 trillions, so then this is the approximate of 2019. Morocco is 118 more or less. Okay, and its population is 3,300 million. For the United States, then the approximate GDP is the 21 divided by 330, which is approximately 65,000 per year. Okay, per year per person. GDP is in the three approaches. There are three approaches of calculation: production approach, expenditure approach, and income approach. Actually, the expenditure approach is the one that I just explained earlier. Okay, the components of the GDP, because actually was the first let's say method that was put in place by many countries, but later on countries, they valued the GDP using the outputs, or what we call the value added or production. Okay, there is a slight difference between outputs and gross value added, but it's fine. Anyway, we can say by outputs. So by expenditures, what we said: final consumption, gross capital formation or investment, government spending, and exports minus imports, which is net export. By output, the GDP, which is what we explained in the previous video, the prices times quantities for every single sector. Let's say we do the sum to get the aggregate, minus intermediate consumption, those capital goods that we used into the process of production. And then by income, GDP, wages, profit, interest, and rent. So as you see in the economy, all activities result in paying the services, paying the income. Okay, if accurately calculated, those methods, they have to result into the same amount. Okay, and this is clearly, let's just say, identified into the circular flow model. Because, for example, between household and businesses, the businesses, they pay household for the work they do. Okay, and also the household, they pay for the product they buy from the producers. Okay, so you can understand that by the end there is a kind of an equilibrium into the circular flow model, and that's why it explains that those methods, they should result into the same calculation. Okay, so as you see in the income approach, wages, salaries, interest, rents, corporate profits, indirect business taxes, and the capital consumption allowances, which is, the depreciation. Okay, if we exclude the depreciation from here, we get the net GDP. Okay, the expenditure approach is the one I explained, and the production approach, the GDP, which is the sum of gross value added, and gross value added is the output minus intermediate consumption, plus taxes less subsidies, because taxes here on products. We have to be careful, because in the income here, for example, in the income approach, we use taxes on production. Okay, here we use the taxes on product. Taxes on product, like the value added tax, less subsidies. Why we do plus minus subsidies, plus taxes? Because the taxes, they increase the price. However, the subsidies, they decrease the price. So that's why plus taxes, less subsidies. Okay, so here is the summary of the approaches we use. This is just a summary. It is in French, but anyway, it's the same. So, for example, for the production approach, the gross domestic product calculated by value added minus plus taxes less subsidies. So here we consider taxes, as you see, on products. It's not like in when we use the income approach. Here the taxes on production and imports, okay, which is different. Okay, I'll give you some insight on the difference, but anyway, not to mention the value added is the output minus intermediate consumption. The output differs from sector to sector. So, for example, there is output of industry, which is the production. There is output of the trade. For the trade, for example, is the margin realized from a good purchased for resale. The output of banks, for example, the interest received minus interest paid. The outputs of insurance, which is premium minus claims. The non-market output, which include the general government, the non-profit institutions serving households, the own accounts for construction, the own account research and development, the own account software and development. When I say own account, I mean production for own use. So this is actually the subject of the national accounts or the specialty of national accountants. But anyway, I provided here some of to deepen your knowledge on those aggregates and indicators. For the intermediate consumption, can be, of course, the production that is used, like tools, for example, saws, spades, knives, axes, hammers, screwdrivers, forklifts, whatever include. And then we have, like I said, the taxes on product, like the value added tax, and also the custom taxes, etc. And then we have the subsidies on products. For the approach, the second approach, which is the demand approach, or the expenditure approach, or the expenses approach, or the spending approach, all these are the same names for the calculation of the GDP. And we have the final consumption that we explained earlier, the gross capital formation, which includes the fixed capital and the inventory, and then exports minus imports. And finally, we have the income approach, which is compensation of employees plus gross operating surplus, and taxes less subsidies on production. Basically, those are taxes payable by employers to carry out production, irrespective of sales or profitability. So irrespective of the profit. Okay, they may be payable as license fees or as taxes on the ownership of use of land, buildings, or other assets used in the production, or on the labor employed, or on the compensation of employees paid. Okay, so there are no taxes paid on values of sales or produced outputs. So they are not respective regarding the outputs. So it's regardless the outputs volume or the outputs produced. So those that they take into consideration the produced outputs or the value of sales, they are called taxes on product that we use here in the first approach of production, right? Okay, for the gross operating surplus is the value added, is the residual that we obtain from deducting from the value added the compensation of employees, the taxes less subsidies on production, and compensation of fixed capital. Okay, I invite you, of course, to see other books that they do the linkage between the business accounting and national accounting. But here I limit to these concepts so far. For the income approach, is the same as the previous formula. They give the same. Like when I say compensation of employees, profits is like a gross operating surplus, the mixed incomes for rents, and then taxes less subsidies. So it's the same, just different names. Okay. For the world outlook, you can see that USA on top and Canada, let's say, in the 10th position. So it's 21 trillion. For Morocco, as I said, 100. And actually, those are the components. Back to the components. Now we use the gross national expenditure plus the external balance on goods and services. And for the gross national expenditure, it includes final consumption expenditure plus the gross capital formation. And for final consumption expenditure, it includes household and government final consumption. Those things I explained. Okay, for the limitations of the GDP, as you see, here we have environmental concerns. There is a curve that is called Kuznets, and I invite you to see at what it looks. Leisure time, stress, and HDI. So those are kind of limitations because they are not considered into the calculation of the GDP. And I invite you for the HDI to see this video of 1 minute. Thank you for watching.